Hi, I'm George Nordhaus, and today I have as my guest Al Diamond of Agency Consulting Group in Cherry Hill, New Jersey. And we're going to talk about agency valuation, very, very important to every agent. Why should you? How do you value it? How do you value your insurance agency? How often do you value it? Well, all those points. Al's going to be talking about that, and if there's anybody that knows it, it is he. He has been a consultant for a long, long time. He was the past president of the consultant organization for insurance managers. In fact, he helped form that. He publishes something called the Pipeline, which we pass on as often as we can to our IMMS members. He's been a consultant for a long, long time, an expert witness. We recommend Al constantly to any of our agents when we can who have who have need for valuation and actually agency sales management, and a lot of other subjects. He has a real fine organization, and we're proud of him. Al, let's get started by saying why, that is, should every agent value his or her agency?
Well, thank you, George. Valuation is something that is a benchmark for agents. For most of them, their primary asset. Along with earning a living, they're building an asset value. And so they need, if for nothing else, for estate planning purposes, to establish how much life insurance they need to know how much their agency is worth. But beyond that, if you're an active agency with one or more partners, or you have buy-in potential or buy-out potential when it comes close to retirement, you want to have stock valuations on an annual basis. And this can be routinely done by us or by others who are in the valuation business. There are many agencies out there who have established ESOPs, employee stock ownership programs, where everyone in the agency, for all practical purposes, is an owner, and that requires an annual valuation of the agency. There also is a great reason, especially in family-owned businesses that are perpetuating down from one family member to the other, to have a track record of values of the agency over time for the IRS. That way, when an event occurs, either a planned one through a retirement or an unplanned one through, unfortunately, the death of an agent, and a value is constructed for that agency, the IRS doesn't look at it and wonder whether this is a high ball or a low ball valuation. If they see a track record of historical valuations and this one just falls in line, then they know that it's a good standard valuation. The primary one is for internal perpetuation of the agency. Whether through family members or not, you need to value your agency for those reasons. And certainly, when you buy, when you sell, and when you merge, you have to value one or all the agencies involved.
What's the main reason?
Finally, before we hit that main reason, unfortunately, more and more are going through this. Divorce requires valuation of the agency.
Oh, yeah, that's tough. I see that a lot.
The worst thing that you ever have to face is not a divorcing spouse, but the lawyer of a divorcing spouse who thinks that the agency is worth many times more than it really is.
I can speak to that, but I don't want to get there now. I understand. So what's the main reason? If you had to have one reason.
Well, the main reason to value an agency is to know how much your most valuable asset is worth. Earning a living is only one part of it. You don't expect that asset to be worth nothing, and it does get more and more valuable as you build that business. And you ought to know that's your benchmark for the success of your agency.
Well, we hear all kinds of terms related to agency values. What's the difference between value and fair market value?
That's a good question, and there are a lot of terminologies here. First of all, an insurance business, almost any business, is worth at most what you or someone else can earn by operating that business over a reasonable period of time. That's the value. It's the value to you if you're establishing your own agency's worth, or the value to you if you're establishing someone else's agency as it is worth to you if you were to acquire it. However, there's a big difference between the value and the fair market value. The fair market value is defined. The definition is the amount which a willing buyer and a willing seller agree will cause the agency to change ownership in a merger, acquisition, or other form of an association. You don't need a fair market valuation if you're doing an estate plan where you intend to continue operating the agency yourself. You're not going to sell it. You're not going to change owners. You're going to run it as a continuing operation, and we have valuations for that purpose that go beyond fair market values.
I see. Well, is value or fair market value the same as the price of an agency?
Not even that. There's a difference. The price is negotiated, and it's the amount between a buyer and a seller, taking into account all the risk factors and the rewards to the buyer or to the seller that might either discount the value of an agency or enhance the value to build it to a cost for the buyer below or beyond the noted value of the business. Now, as an example of that, if you are buying your next-door neighbor and he's the only other agency in town, you may actually spend more than the fair market value of the agency, the earnings potential of that agency, in order to eliminate a competitor. And there are other reasons like that the price can go up, or sometimes the price can go down.
All right. I've got the difference now. Now, let's shift gears here and talk about the practical parts of the legal parts of the sale. Should an agency sell its stock or its book of business, or its book? Just its stock or its book of business? What's the difference?
That really depends. Stock, you're buying a corporation. It's appropriate sometimes for internal perpetuation. If you're selling down, you're not going to evolve separate corporations every time you do that. And the buyer, whether it's a child or an employee of the agency, is basically buying the stock of the agency. It's not appropriate in most acquisitions. In most acquisitions, the buyer simply wants the book of business and wants to actually avoid buying the other assets of the corporation, because when you buy the corporation, you're also buying the liabilities. So it might not be right for a merger either. You might go on a different factor, just acquiring assets, depending on the conditions of the merger. Some mergers where we have tax-free exchanges, stock-for-stock buy-ups, you're actually trading in the stock of both corporations into a new one.
Got it.
Now, stock sales, as I said, will buy liability as well as assets, and that has to be noted as a positive or negative depending on the condition of the acquisition or the reason for the valuation.
Can an agent value his own agency? Can we do that for ourselves? It is a do-it-yourself project. I've always wondered that some agents do it themselves, and I kind of wonder how their valuation really compares.
Well, sure you can. It depends on the agency. There are a lot of agents that you and I know, George, who are great analysts, good financial people. There's no reason. This isn't brain surgery. Anyone can do this. It can be done yourself. But do you really want to do it yourself? Just because you're a handyman and can work with wood, does that mean you want to build your own house? Mm-hmm. Probably not. However, you should certainly understand how to do it, because if you don't, it looks like voodoo to you. It looks like magic, and it isn't. And there are reasons behind every part of the calculations of value with respect to an insurance agency.
Oh, I totally agree. And I think there's, you in the East Coast and others in the East Coast too, and we have some out here west. You guys really, you see this all the time. You know the value. You walk into it, you can feel it and taste it and smell it, where the guy is, you can't see the forest for the trees if you're running the agency.
Well, that's true, but every agency is also somewhat different, and that's one of the reasons that you have to go through the entire process every time. And even though we have done virtually hundreds and hundreds of transactions, we approach every one as if it were completely fresh, and we do it from the ground up and follow every one of our rules that we'll talk about in a couple of minutes.
All right, well, let's talk about those rules. What you've got rules on criteria, the criteria of valuation. What are they?
Well, the Bible for valuation, and something that everyone should get their hands on if they want to construct their own values, is the IRS's revenue ruling 5960. It's the genesis of valuation. And while it's pretty technical, it does put together all 8 factors that the IRS wants you to look at when you value a business. For instance, the first 4 are here on the slide. It's the nature in the business and the history of the enterprise. That's one of the reasons that every agency valuation is different. All of them start differently and progress differently. Then number 2 is the economic outlook. That's the economy in general, could be regional, could be countrywide, could be local, and the specific outlook for the industry, for the insurance economy. And that changes on almost a year-to-year basis, and things are changing as we speak, as you're well aware.
Yeah.
The third one is the book value of the stock and the financial condition of the business. So when we're doing a valuation internally for estate planning purposes, we're looking at hard asset value. It was just yesterday that I was with an agency that we were doing a valuation. The owner, it was an issue of an owner who was passing away, and everything was going swimmingly until someone mentioned that they had $1.5 million of cash in the bank. And I looked at them and said, do you realize that this will boost the value by literally $1.5 million because it's a dollar-for-dollar boost. This is hard net worth. And that they might want to do something with that before we value the agency for the next situation that agency was going to face, and they are certainly going to do that. Number 4 is the earnings capacity of the company. Now, earnings is different than revenue. It's different than premium. It's different than commission. It's not even profit. Earnings is after-tax income that generates to the owner of that business or to the valuer of that business. And the earnings potential of the agency is the basis of the value of the business. We'll talk about that more. Then there are the other 4 items that we're going to look at that the IRS claims are the issues that they look at. The dividend-paying capacity of the company. If we pay fair compensation to the owners and employees and all expenses, will the company be able to throw off dividends? Does the company have goodwill or other intangible value? And for us in the insurance business, number 6 is a key because all of our value, with the exception of that hard net worth, is the intangible, the goodwill value of the agency. Mm-hmm. They also want you to look at the sale of stock and the size of blocks to be valued historically and across company lines. This is one of the most difficult things that we have to do. Some valuers will try to look at big corporate acquisitions and sales and then use those as comparables for a small agency transaction. We find that it's not valid because they're not similar companies, and it has to be a similar company. And finally, the market price of stocks and corporations engaged in the same or similar lines of business that have their stock traded in the free and open market. And when we do valuations of publicly held companies, we do our comparables the same way anyone else does against transactions that have occurred for other stock companies.
Al, how do you calculate value? I've heard all my life it's worth 1 time, 1.5 times.
Oh, yes, the great multiples.
Great multiples.
If I'm asked once, I'm asked 15 times a week, Al, I don't want to take up a lot of your time. Just tell me what the current multiple is. And it always puzzles me until I realize that multiples were created to simplify value for agents on the back end. Once you create a value for an agency, it's very easy to turn it into a multiple of something. So if your agency does $1 million worth of commissions and your agency sells for $1 million, you just got one-time commission for that agency. Now, does that mean that the next agency down the street is also worth one time? Or that the agency in San Francisco and the agency in Dubuque, Iowa is also worth one time? I don't think so. And so it's impossible to measure the multiples because you always ask, what is it times of? And that's why we get into the rules of thumb in insurance agencies and in valuations, where some people talk in terms of multiples of revenue. That's total income, including contingency and interest income and any form of fees or other income. Some talk about multiples of commissions. And that's purely the commissions that you get, either P&C commissions or financial services commissions, or both combined. Some people talk multiple of earnings, after tax, profits after taxes. And a multiple of earnings is how we do a lot of work with our public entities and brokerage houses. And then there's the interesting term EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Unfortunately, all of those combined, if a valuer tries to tell you your agency is worth 9 times earnings, or 12 times EBITDA, or 2 times commissions, or 1.5 times, that's really shooting from the hip, and it's not basing it on that agency's particular situation, and we call that valuation voodoo. When the agents who call me try to insist that I give them some multiple, I suggest to them that they ought to take $10,000 times the number of chairs in the agency. When I usually get either a hang-up or silence on the other end of the line.
What do you mean, Mike?
What do you mean, the number of chairs in the agency? I said, well, it's as valid as anything else, and if you wanted the agency to be worth more, just move more chairs in.
So what's the real value of an agency?
Well, the real value of the agency is constructed a little bit differently. Unfortunately, it's not that simple, but it can be done. The real value of any agency is its future earnings potential over a reasonable period of time, under circumstances specific to the valuer, just at the point of time that the valuation is being done. What that means is, if you're valuing your own agency internally for estate planning purposes, you intend to continue, you're 45 years old, you're going to be in the business for another 20 years, you're going to take what the future earnings potential is of your agency, the way it's operated now, and that's going to become the basis of value. Now, the question should be, how do you determine the future earnings of your agency?
Right.
I mean, you know historically what you've done, but nobody can read the crystal ball. And the answer is, you've got to go by the trending of your agency. If you can look at every line of revenue and every line of expenses, and you do this by line, and you eliminate non-recurring activities, either big accounts that you've written once and you're not going to write again, or accounts that you've lost that will diminish your revenue once but not again, those trends determine what you're going to do in the future. Because if you know what you've done for the last 5 or 10 or 15 years, and you're not doing anything differently now, that's probably how the trending of your agency is going to go into the future. So what we do is we determine historical trends of revenue and expenses. We adjust those trends for expected changes, either in your agency by what you tell us, or in the industry by things that we find out about, like the contingency agreements that are changing as you and I speak.
Mm-hmm.
And we calculate risk factors specifically for discounting the agency. Those risk factors fall into 2 categories. One is inherent to any business, things like the time value of money. And the other risk factors are specific to your agency, related to the age of your employees, the health and age of your accounts, how closely your accounts are tied to you, how many or how few accounts you have. These are all questions that are asked within our valuation questionnaire that helps us determine whether your agency is a high-risk agency, which means that the value is discounted, or a lower-risk agency, which means the value can actually be adjusted upwards. Mm-hmm. Now, we also determine how long you're willing to give up the earnings to buy an agency. If you're looking at the value of an agency that you're going to acquire or merge into your firm, one of the things you have to say is, when I value this agency for myself, how many years will I be willing not to take any money out of the agency in order to pay for it? If I'm willing to take money for not take money for 4 years or 5 years, those 4 or 5 years worth of earnings is how I construct the length of the earnings stream that develop into the value.
That makes sense. Kind of common sense here, isn't it?
That's all it is. It's common sense applied to a disciplined approach. And as we get further into this presentation, I'll help the agencies if they want to try it themselves or educate themselves. I'll give them all the data they need in order to do this kind of activity. The historical trends on revenues that we're talking about is the traditional revenues of an agency. So we trend P&C commissions. In agencies that actually have the historical data, we'll trend them down to individual personal lines and commercial lines trend of revenues. We trend contingencies. Really interesting concept, since the contingency income is changing as we speak with Travelers and Chubb and some other companies eliminating what used to be iffy contingencies up to the end of the year to determine how much money, bonus money, you're going to make next year. And some of them are actually trying to solidify this into a guaranteed bonus for historical performance, which is a terrific idea from the standpoint of all good, healthy, profitable insurance agencies.
And
we're hoping that they're not just going to eliminate contingencies altogether.
I don't think they are, and I think that'll find its level anyway.
I think so as well. Now, in the past, what we've done is if an agency has had strong contingencies consistently over a 5 or 10 year period, we assume that's a trend. If their contingencies go from zero to thousands and tens of thousands of dollars year by year and it never trends, then we don't include contingencies as a part of the valuation. But if there's a trend, we'll look at it into the future. Life and health income has to be looked at in a different way than P&C. While health income is continuing income, life income depends on sales activity on a year-to-year basis. So as long as they keep and maintain and grow their sales force, we can trend life insurance income forward. If their sales force is eliminated or it's just a one-time activity and we see that there's no trend involved, then we won't trend that income either because it's so front-end loaded. Investment income. Investments in this case really is interest income, and that's for our friends like the agency I visited yesterday that had $1.5 million in the bank. They do make a considerable income from that. Sure. Even in the worst of years, there are very conservative agencies that like to be cash rich. That's fine in most cases, and that investment income is trended, as are fees, which are getting to be a more and more important part of agency incomes, especially on the West Coast. And it is drifting east, and as we go to more and more net premium policies, fee income is going to be an ever-increasing part of our agency income. And, of course, other income that it develops within agencies on a regular basis. Now, on the other side of that, we look at historical trends on expenses. The most important one is compensation. Now, we have executive and management and compensation together. We look at sales compensation separately, except in smaller agencies where the executive and the salespeople are primarily the same group. And then we trend that expense forward. Now, we know because of our work in composite groups, we do the composite groups for the industry, as you know, we know what the averages are industry-wide on all of these expenses. And especially on executive and management and sales costs, if owners are paying themselves too much or too little, we can normalize those expenses for valuation purposes based on the specific needs of the agency, whether it's for acquisition or for internal perpetuation.
Right.
Office expense, office compensation is a very important part. There are some parts of the country where obviously office expenses are much higher than others, and we trend that forward. Costs of employment involve two separate things. It involves payroll taxes and taxation issues that are sensitive to the number of employees. It also involves benefits. So those costs of employment are an important part of trending of expenses. And by the way, if an agent does this themselves, or if they have us or another valuer do this, these kinds of trends of revenues and expenses should be looked at not only for valuation, but for the operation of the agency. Here's where they can see red flags if things are happening that are not healthy for the agency, that they can go and attack in different ways through their operations. The next thing we look at is sales expenses. These are typically travel and entertainment, auto expense, and advertising and promotions. We trend those and trend them forward as we do operating and administrative expenses. And the result of this is trended forward for at least 5 years to determine what the raw earnings stream is going to be. Now, to that, we make adjustments. And we adjust every line of revenue and every line of expenses in accordance with any alterations that are reasonable to be made in order to build a pro forma view of the future income and expenses of that agency for at least 5 years. And then we adjust every line by accepted changes, with one major exception that we need to train insurance agents not to do. And you don't bet on the come. And what that means is when an agency is looking to buy another agency, they like to lump into the value, potential value of that agency, any cross-selling that they might do that that original agency may not have done. We warn against that. That's a sucker bet, because you never know whether that cross-selling has already been done through another agency, or whether the cross-sell potential is there. And you can't bet on writing business that's not there yet.
I think that's really good advice, because I've heard that so many times. Oh, well, we're going to really cross-sell these things, and those guys didn't do it, and boy, it's going to be worth 10 times because we're going to do all that.
Right. You take something and you highball the value. You say, okay, if the man wants $2 million, I'll give him $2 million, when the cash flow of the agency will only realistically stand $1.25 million, and you don't do that cross-sell, you're going to be $750,000 out of pocket over a period of time that you're paying for that agency. And while it doesn't sound like much of an important thing initially, when you have to dig into your own pocket for $75,000 or $100,000 a year for a certain number of years in order to pay the agency expenses and the payout, you're not going to feel really good about doing that transaction. And it's going to stifle you from doing more in the future. We would rather you be conservative. If you lose it because the agency selling is truly expecting more than the agency's worth, it's better to walk away than to be the loser in the acquisition.
All right, let's just touch on the risk factors for a minute here, because our time is coming nigh, and give some action steps.
Okay, the risk factors. First of all is the time value of money. This is a pretty standard approach. We use the 10-year T-bill rate, and that risk factor doesn't move with inflation or deflation more than a few marginal points in any given year. However, the more important risk factors are the ones that are involved with the insurance companies, with the clients of the agency, and with staffing considerations within the agency, whether it's the old owner or the employees, that may increase or decrease the risks associated with you taking over an agency and valuing it, or you continuing to run your own agency. I was in an agency recently where we had an 80-year-old customer service rep who controlled a large book of business, and a 75-year-old producer who was getting ready to retire who also controlled the large book of business. Well, I can tell you when I did the valuation on those, there were some discounts applied because they hadn't properly backed up those people. When they left, they were going to hire their replacements, but we don't know what's going to happen to those books of business that were virtually controlled by those two people. And that's an example. Now, combining all of these creates a subjective discount rate that's applied against the raw earnings potential. And you may have a 10%, a 15%, or 20%, or some range in between, or more or less, that you apply against the total earnings in order to reach the final value of the agency.
That's the final thing. It all boils down to this last slide here, doesn't it?
Well, it's how long are you willing to wait for your piece of the rock. When you determine the value of an agency, what you're saying is, I'm willing to give up, if I'm buying an agency, for a certain period of time, some or all of my cash flow. And that cash flow is the excess earnings that agency is going to throw off for me as the owner by my projections. If I'm willing to wait 5 years where I get absolutely nothing for that agency beside the operations and paying for the operations, then 5 years worth of earnings comprises the appropriate value. If I'm willing to wait 10, I can increase the value of that agency. However, if I, as most agents say, that I have to have a positive cash flow from day one, it doesn't have to be a lot, but it has to be a positive cash flow, then a factor of the total earnings is the value of the agency, not all of them. And that's what the agent has to look at. That's what we look at with an agency when we value them. So the action steps here is, first of all, know your agency. If you're doing the valuation yourself of your own agency, we would be more than happy, whether we're doing the evaluation for you or not, we'll send you a valuation questionnaire.
That's terrific.
So you'll know exactly what we ask for, step by step.
That's terrific. I'll give you your on the next slide, I'll show you how to contact you.
Great. What we do here is we allow you to gather all the information as if we would gather the information. Trend your revenues, trend them by line, and trend your expenses by line. If you do that, you're going to be able to project your future revenues and expenses from your trends. Now, we have a piece of software available for only a few $100s that will allow you to do the same calculations we do, and it's an interim step if you'd like to try to do your own valuation. If you find that you can't do it with that software, we'll apply the cost of that software against our valuation, and we'll just do the valuation for you. Or you can call us in right from the outset, the simplest way, and there are other valuers out there in the industry who are great and do similar kinds of valuations. If you hire a professional and you use a professional to do your valuation, you know you can count on them backing you up if there are ever any IRS or court questions responding to it.
I think that's important, and I think that we should end by letting me remind people that you have, over the years, developed a dynamic list of or library, or I'm not sure exactly what you call it, encyclopedia of agency cost. You have over 3,000 agency numbers in your database now, don't you?
About 3,200 agents in the last 12 months have supplied us financial information that we combine into our composite groups. Now, we never know which agent provides which information. It's all done in the blind. But it's good, solid information that allows us, by size of agency, to determine what the averages are for every line of income and expense and for balance sheet items.
It's an amazing thing that you've done for the industry right there, and I would recommend people, you can go on our website and you can find it there in our library and participate in it. Al's happy to have you. There's no cost to it. It's a beautiful thing, and then if you want more information, he can follow up with you. Al, thank you very much for your time. This is a great basic primer for selling an agency, and I don't think anybody could have done it any better.
It's my pleasure.